Let's kind of talk about Davos first, okay? I know you're not there, we're not there, but a lot of the global elites are, and they are going to be talking about climate change. I was reading some notes of some commodities traders, and they're actually looking closely at Davos this year for any signs on initiatives on climate change and what that will mean for the commodities markets, in particular oil. What's your take?
Well, one of the points we're going to be watching for is really the potential for carbon capture technologies. We think that's got to be part of the broader solution here. And there's several reasons for it. So such that when you think about the price of carbon, $100 a ton represents somewhere around $40 a barrel. Price is at $60. You add $40 a barrel on top of that. That's $100 a barrel. We have been there before. You can get up about half of the solution with about $100 a ton carbon tax. You go much higher than that, you start to run into the problems of higher prices creating income inequality issues. You see that right now with the Gilets jaunes in France and movements within Netherlands and other parts of the world, particularly the U.S. when you get to higher energy prices. So when we start to move higher, carbon capture becomes an important part of that solution. One way to think about it, conservation is really a regressive tax, which is why you have to hit the cap on that price. And you can think about carbon capture technologies being more of a progressive solution here. So we're really going to be focused on the potential for carbon capture technologies.
Well, the immediate market's really looking at the oil price now. You have a price target of oil, what, $63 a barrel? It's around 65 for Brent right now. But you see yielding much higher as you're bullish on commodities for 2020.
Well, let's take a step back and ask why we're bullish on commodities. And the answer for that is we see declining investment across the commodity space. You look at energy, you look at the rig count. The rig count has continued to fall over the course of the last year. You look at metals and mining, investments off sharply. And if you think about commodities as being part of the broader old economy, we look at the old economy, it represents 35% of GDP, but it has 2/3 of the corporate losses. It has 90% of the non-financial debt. And the reason why it has such a large share of the non-financial debt is it produces physical assets. Physical assets can be collateralized, hence so much debt. The third one is they represent 80% of emissions, going back to why this is going to be a big issue at Davos. So the other words I like to say is you look at the old economy, they are overbuilt, over-levered, and over-polluted. And all three of these factors create a sharp decline in the ability to invest. Let's talk about overbuilt. Poor returns, capital gets redirected. Over-levered, they have to take most of their cash flow, pay back debt, as opposed to putting it into the ground. And then the third, over-polluted, because they're the target of emissions, capital is being restricted from the sector. As a result, investment's declining. Now let's bring it back to oil and the roll yield there. So we start to see a tightening of the market, aided by OPEC cutting back production. That puts upward pressure on the front end of the forward curve. But then, because they don't have access to the debt and equity markets, they sell the back end of the curve and you get a rotation of the curve. That's where you get that 15 to 20% roll yield from owning on oil. So our forecast is $63 a barrel. Market's trading somewhere between 64 and 65. So the price we expect to come down a tiny bit, but the return's going to come from rolling that front end.
So you do see a ceiling, even though there could be some disruptions in the Middle East. We've seen it already in Libya with the pipeline. We've seen in Iraq a temporary halt this weekend, I believe, at one oil field. You have the uncertainty with Iran as well. So is there a ceiling on the price, you think?
Well, we've witnessed that and with upcake back in September in the oil market, and you saw it with Iran at the beginning of this year. It would have to be a very substantial disruption to push prices above $70 a barrel on a sustainable basis for several reasons. One, the U.S. is still sitting on an enormous amount of inventory, the SPR. In fact, you go back to in the fourth quarter of last year, the U.S. officially became energy independent. So it has all of these strategic reserves that it doesn't need anymore. And then you look at the emerging markets. When we used to go up to $100 a barrel, bringing it back to the issue of income inequality, is that they used to subsidize prices. So the price could go up very substantially, and the people in these countries would not feel it. Yeah. The problem is today those subsidies are gone. The price goes up. They feel it. The demand drops off substantially.
Let's switch to three metals. Palladium, obviously, in the focus right now, but also gold and copper. Let's start with palladium. It's up at $2,500 an ounce. It's up 30% already this year. How much more room does this have? I mean, this is a commodity and a metal that is used primarily in catalytic converters, old combustion type engines in the automobile market. Aren't we moving to EVs?
We look at the demand for palladium. Why did it take off so much? This goes back to VW. When VW had to switch out of diesel cars, platinum is the primary auto catalyst in diesel cars. Palladium is the primary one in gasoline. So we saw a reduction in platinum, an increase in palladium. Same time we have problems on the supply side. So that's the genesis of the issue. Now we think about what has to happen to cause these gasoline auto cats to switch to palladium. The price is really not going to do it. One of the reasons why is it's still such a small proportion of the overall cost of the car. So what needs to happen? You need to have physical disruptions that are so large that starts to disrupt the ability to produce these cars. We're not there yet, which is why the thing, I think it was on Friday, we rallied 10% almost
EVs
overnight.
Are further down the road to halt this rally.
Right. And when we think about EVs, it's a different group of metals. It's more focused on batteries and more on electricity like copper and the electrical part of the supply chain.
Can't there be substitutions into platinum, though?
It's
less than half the price.
Absolutely. Platinum, rhodium. Rhodium is another one that rallies substantially.
Spiking towards records as well.
In fact, we like to call this the instead of the new gold rush, the new precious metals rush. And one of the key reasons for here is they're all critical in terms of both thinking about these industrial applications more broadly, but second of all, you have the monetary demand for gold and platinum, which is also helping to support the overall complex.
Well, let's talk about gold and copper. Copper is your most bullish call, even though there's disinvestment or slowing investment in copper as well, that you talked about earlier. But then gold, safe haven?
Absolutely. When we look at gold, there's three key reasons we want to hold it. One, a very good hedge against geopolitical risk. We go back to Iran a few weeks ago. Typically, you get a much better response in owning gold than you do oil in those situations. You don't know if for sure it's going to lead to a supply disruptions, but for sure, gold is the one that typically gets the upside. So geopolitical hedge. Second reason we like gold is de-dollarization. De-dollarization is really critical, and one of the key reasons for that is that when we have a lot of sanctions and other geopolitical risks going around the world, owning the dollars gives you exposure to these types of events. So owning gold diversifies your way out of it. When we look at the demand from central banks last year, it was 750 tons, the highest since the Nixon era, and 22% of global supplies. The third reason we like gold is we talked about before, if CapEx is coming down, and we think about savings equals investment in equilibrium, and investment's going down, we start to get a savings glut. Where do you put these excess dollars? They end up going into gold, all supportive of our $1,600
So copper,
target.
really quick, a number of stories involved there as well, including the Phase 1 trade deal and China's consumption, if they're going to get back on track. What's your outlook?
Our target there is $7,000 a ton, so we see modest price appreciation there. It, too, is suffering from lack of investment, like we were talking about before. But the one thing it does have, it has a very idiosyncratic demand story. Chinese grid, an important part of that demand story. We're seeing it's starting to surprise to the upside. Inventories are declining. So we'd expect the key issue with copper is you need to get the investors to buy into the story, shift the market from being short to being long, and we think that'll push you up.
So that's an 11% increase, your $7,000 an ounce call. Quickly, iron ore, this part of the world, of course, in Australia, a couple of big producers, BHP and Rio Tinto, they're talking about upping up supply this year after disruptions last year. What's that mean for prices? I would assume it's going to be sagging prices.
Well, you look at inventories, they're quite low. And I think the big surprise last week is that China did not rebuild inventories going into the Chinese New Year. And what we talk about in commodity markets, when you have these very low inventories, you go into what we call a demand rationing phase, where inventories are low, demand tries to pull ahead above supply, prices have to spike to bring demand back in line with supply. We went to $120 a ton last year. We think we're brewing for another type of spiky environment in 2020 going forward. This iron ore, I like to say it's the canary in the coal mine. Embodies everything in the commodity market. You have the environmental issues coming off the back of the volley incident last year. You have low inventories, Chinese demand, it's benign, not too weak, just enough to keep the markets tight.